Ask any seasoned retail investor what they most want to own, and you'll hear the same answer again and again. A grocery anchored center. It's the most defensive, most coveted asset class in all of retail real estate. The reason is simple. No matter what the economy does, no matter how much shopping moves online, people still have to eat. Here's the economics of the grocery anchored center and why investors will pay a premium for that supermarket out front. So, what makes a grocery store the perfect anchor? Three things. It sells necessities, so demand is steady through any economy. It brings customers back week after week, not once a season, but constantly. And it has proven remarkably resistant to e-commerce. Even today, only around 12% of grocery is bought online, and much of that is click and collect, which actually pulls shoppers into the store. No other anchor checks all three boxes. A typical supermarket anchor runs 40 to 65,000 square feet and signs a long lease, 15 to 20 years or more, with renewal options that can extend its commitment for decades. A healthy grocer does $400 to $700 or more in sales per square foot. That sales productivity is the single most important number in the whole center because it tells you how committed that anchor really is to staying. Here's the magic of the structure. The grocery anchor itself pays relatively low rent, maybe $10 to $16 a square foot. It's not really there to make you rich directly. It's there to be a traffic engine. Every one of those weekly grocery runs sends shoppers streaming past your inline tenants. The dry cleaner, the nail salon, the sandwich shop, the urgent care. Those small shops pay 2 to 3 times the anchor's rate to capture that built-in foot traffic. So your net operating income is really a blend. Stable, low rent income from the anchor that underwrites the whole center, plus higher margin rent from the inline shops that the anchor's traffic supports. Keep that center 95% leased behind a healthy grocer, and you have one of the most dependable income streams in all of commercial real estate. And if you're investing in Florida, one name towers over the category: Publix. A Publix anchored center is the gold standard of this state's retail real estate. The company is financially rock solid. Its stores post some of the highest sales per square foot in the entire industry, and Publix anchored centers rarely come to market. When one does, buyers compete fiercely, and they accept some of the lowest cap rates in all of multi-tenant retail to own it. The leases follow the familiar net lease playbook. The anchor signs a long-term lease and typically reimburses its share of property taxes, insurance, and common area maintenance. The inline tenants sign shorter triple net leases, which lets you mark their rents to market as the trade area grows. It's a structure built for steady, escalating income with very manageable hands-on work. Anchors lock in 15 to 20 years or more, which gives the center stability and makes it financeable. Inline shops roll on 3 to 7 year terms with built-in escalations, so your income climbs steadily and resets to market as leases turn. The strongest centers carry the strongest grocers: Publix, Kroger, Whole Foods, Sprouts, names with the credit and staying power that buyers want to see. Because they're so defensive, grocery anchored centers trade at premium pricing. A center anchored by a top grocer in a strong market changes hands around 5.5 to 6.5%. Step down to a regional grocer or a secondary market, and the cap rate rises to compensate for the added risk. These are larger assets, typically five into the tens of millions, which makes them a target for serious private and institutional buyers. Before you buy, study the anchor's vital signs. The two numbers that matter most are sales per square foot and occupancy cost, the rent the grocer pays as a percentage of its sales. A healthy grocer with strong sales and a low occupancy cost has every reason to renew and stay for decades. A weak store with thin sales is a dark anchor risk waiting to happen. The grocer's health is the foundation the entire investment rests on. Now the risks you can't ignore. The biggest is a dark anchor. If the grocery store closes, co-tenancy clauses can let your inline tenants cut their rent or even walk, and the center's whole value can drop. Grocery is also a competitive, consolidating business. Discounters like Aldi and the dollar chains keep pressing, and online grocery keeps inching up. The defense is the same in every case: a strong grocer, healthy store sales, and irreplaceable real estate. And underneath it all, you own a large, well-located piece of necessity retail real estate. A grocery-anchored center sits where the rooftops are, surrounded by the households it serves. In a state like Florida, adding roughly 1,000 residents a day with no state income tax, those trade areas only get deeper and more valuable over time. Necessity retail near growing rooftops is about as durable as commercial real estate gets. Putting it together, the grocery-anchored center is the blue chip of multi-tenant retail. Defensive, necessity-based income, the traffic engine of a strong grocer and real estate that sits right where people live. Pricing runs from 5 into the tens of millions, and the category is a perennial favorite of 1031 buyers and institutions looking for durable, recession-resistant cash flow, especially here in Florida, where a Publix on the corner is about as good as it gets. Grocery-anchored centers prove that the most defensive real estate is often the most valuable. The economics reward investors who understand anchor health, tenant mix, and location. If you're evaluating grocery anchored or necessity retail centers in Central Florida, that is exactly what we do at MaxLife Commercial. The link to connect is in the description.